Thanks for everyone for joining us today. My name's Jeff Hunter. I'm a portfolio manager with the Townshend, Somani and Hunter Group at Canaccord Genuity. Also on the line are our lead investment advisors, Dave Townshend and Raheem Somani. For more information about our team and the MyWealth process, please check out mywealthmanager.ca. Today's call is with Vision Capital's Jeff Olin. Vision is the go-to name globally for publicly traded real estate securities and recently been onboarded and promoted by JP Morgan on their institutional side. I'll let Jeff and Darren Kosak discuss a little bit about that further. All participants on the call have been muted, but in the chat below, feel free to direct any questions to us and we'll address them in the time permitted. Today's call will be recorded, so make sure to check your emails in the coming day for the replay information or follow our team's Facebook page at facebook.com/mywealthmanager.ca. With that, I'll pass it off to Jeff Olin.
Thank you very much, Jeff and Dave and Raheem, for organizing this today, as well as all the participants. What we thought we'd do to just give you a bit of a roadmap is some of you may be familiar with what Vision do, others not. We don't assume everybody remembers exactly what it is Vision does, even if you do. So take 10 or 15 minutes to make sure you're armed and dangerous in terms of what the strategy is at Vision, because it's certainly at a minimum relevant to the context of our comments, which we will delve into in terms of our outlook, our views, our positioning in various property types, geographic regions, and deal with some of the hot questions in the room, I'm sure. Things like inflation, interest rates, and just leave ample time for open discussion, questions that might come in as well. And we'll be around if it takes a little bit longer. We don't want to take everybody's time. I think the plan is 45, 50 minutes or so. And if we need more time, we'll hang around. So, as I think most of you know, we are focused in real estate. However, unlike pension funds or REITs or entrepreneurs, or other limited partnerships, perhaps, to focus on direct property investments, bricks and mortar. Notwithstanding my background doing that, what we do at Vision is we're focused on publicly traded real estate securities, both equities and debt. We operate long and short. Our strategy is not here, we're not here to be bulls for real estate. We can be short, we have a lot of our own personal capital here. It's designed to outperform irrespective of real estate supply and demand fundamentals or valuations. We seek, where relevant and appropriate, to be active, value-add, strategic investors. We don't seek to be hostile. It can take you 30 years to build a relationship you can lose in one day. But if we can marry our real estate industry experience with our capital market expertise and relationships to add value to our underlying investments, we look to do that. We've had 18 takeovers in our portfolio holdings in the last 12 years. We have flexibility within limits to invest globally. Heretofore, but for a couple of exceptions that were driven by Canadian relationships that gave us some sort of edge in Europe, we tend to stick to North America. We want to be hands-on. We don't make investment decisions sitting in our office in Toronto. We want to tour the real estate. We want to understand the supply and demand fundamentals of the property types and geographic regions within which we can invest. We want to understand the competitive setting and the physical conditions. And it's a mistake to think we're going to be any good in that in Brussels or Beijing. But the core of what we do and the raison d'etre that we exist is to firstly top down look at property types, macro conditions, supply and demand, then bottom up, look at valuations, lease structure, corporate governance, alignment of interest, to establish our view of the underlying value of the real estate, and then compare that value to what is trading at in the stock market. So we seek to buy real estate cheaper in the stock market than one can in the property market by doing so. A number of advantages as to what we do relative to what I used to do are those that buy real estate directly through bricks and mortar. Number one, by definition, you can't buy real estate cheaper in the property market than the property market. Why do we want to be one of these 17 entities to compete against a pension fund, a REIT, an entrepreneur with too much money in his or her genes to buy property in an auction hosted by CBRE or Colliers, when we can buy real estate at 60, 70, 80 cents on the dollar in the stock market, have professional management, have corporate governance, have transparency, get geographic diversification. You might be really good at a strip mall in Calgary, doesn't know you know anything about apartments in Dallas or single family rental homes in Orlando. Get property type, get geographic diversification. Get access to best-in-class properties that may not be available at all in the property market. Even if they are, you might have to allocate too much of your capital, either as an institution or family office, to buy that one-off asset. Nobody calls us in the middle of the night to fix the heater. And we have liquidity. And while liquidity is always important, it's years like 2020, similar to Brexit, where liquidity takes on a different meaning. Where in Brexit, you had multi-billion-dollar real estate funds, Standard Life Assurance, Aviva Insurance. Last year was Great West Life Realty, property funds, and they promised liquidity to investors monthly or biweekly. Brexit comes along and they put up gates, and they're basically, what do you mean gates? I just read the offering memorandum and it says I can redeem here monthly. And they said, don't you know we own office buildings and shopping malls in London, England? Anytime you have a mismatch between the underlying liquidity of your investments and the liquidity you promise your investors, that's an accident waiting to happen. And in 2020, we had a lot of accidents. But the opposite is true. If valuations are excessive or fundamentals are negative or deteriorating, you can't do anything about that in the property market. If you own a shopping mall in suburban Pennsylvania and lose your Sears, turn out the lights before you leave the parking lot. If you own an office building in Calgary, it's going to be 15 years, in our opinion, before you can recover your capital investment. You can't do anything about that. We can, and we did do something about it. In both of those circumstances, we went short. We launched our funds July 2008. That was not a fun period of time. Then little do we know was about to befall us in the fall of 2008, but we persisted, we prevailed. Our funds are up about 390% net of all fees, net of all expenses. Since inception, it equates to about 13% compounded annually. A couple of things about that. One, we don't use any long side leverage. We don't buy stocks on margin. Two, no currency gains or losses in there. We hedge currencies. Number three, we pay a distribution between 4 and 4.5% of the NAV. It gets paid, depending on the fund, quarterly or monthly. 85% of investors choose to reinvest that, but you can change your mind every quarter. I need it, I don't need it. Very tax effective. 80% of our returns on average over the last 13 years have been capital gains. And since Vision is a flow through, that distribution retains the same underlying treatment as the funds. So if you get a distribution of 4.5% and it attracts 80% capital gains treatment, that's like getting 6.25% interest income on an after-tax equivalent basis if you're in a top marginal tax bracket. We've received numerous industry awards. I won't regale you with them. They're there on the slide. Who are we? Three senior guys. Frank Mayer, his background is very simple. Frank was a top-ranked real estate research analyst for 35 years with 3 investment firms, UBS, HSBC, and Desjardins. Also served an executive in various capacities, from chairman, vice chairman, to the toughest job Frank said he ever had was the head of research. My background was 10 years in corporate real estate with Olympia New York Developments Limited, the Reichman family with Bramley Limited. Some of you may remember Bramley if you have a few silver hairs like I do, which was a $7 billion public North American-wide company. I started with Bramley at a grad school in Chicago in 1985 in Dallas, Texas. And I was part of a team that built a 70-story office tower in downtown Dallas. So I've done development, I've done leasing, I've done operations, I've done planning and design, I've done acquisitions, I've done dispositions, none of which we're doing at Vision today, but all of which are certainly relevant to our investment strategy, particularly in some of those active investing opportunities. And as the real estate world went through its depression in the 1990s, it was a depression. I involved in the banking. I was a managing director of banking, leading HSBC's global real estate practice, where I first started working with Frank Mayer in 1997. And then I was head of banking and managing partner outside Quebec for Desjardins. Both Frank and I have significant corporate governance experience. I've chaired public company boards, audit committees, independent special committees. Was asked by the Government of Canada, Stephen Harper's government, to participate in a parliamentary committee with the Government Bank of Canada. So you'll find, and if you're interested, you'll see that we infuse into our fund corporate governance principles that we become accustomed to. The third and key member of our team, and then we'll move on, is Andrew Moffs. Andrew joined about 6 years ago. Unlike Frank and me, he's been, religion has been on the buy side. He was with APG, the Dutch pension fund, the third largest pension fund in the world, but more importantly to us, the largest investor globally in real estate securities with 15 billion in real estate securities. And then one of their large investments was in Starwood, and the chairman of Starwood, Barry Sternlicht, approached them. He wanted to start a real estate securities fund, and Andrew and his boss and the founder left to start Starwood Real Estate Securities, doing long-short real estate alternative fund in Greenwich, Connecticut, where he was for about a decade. I guess about 12, 13 years ago from now, his wife said New York's no place to bring up a family, so they moved back to Toronto. He continued to manage the flagship Starwood Fund and launched a Canadian domiciled version thereof. And he was a great addition to our team in 2015. I'm going to skip over the inefficiencies in our space in the interest of time, but we can certainly go through why our strategy is relevant. And it really relates to inefficiencies that give rise to this opportunity to buy real estate cheaper in the stock market and the property market. Returns, I mentioned earlier, you can see the returns in context to REITs in Canada, United States, or the broad property market index, or other alternative investment funds. Bank of America Merrill Lynch established our benchmark, which is the green bar in the middle, 131%, which is an equal blend of the Canadian US REIT indices and the global hedge fund indices. But the most important thing in our view about Vision are not the returns per se. The returns are great. The most important thing for you to appreciate is that we don't seek to be the best performing fund in North America. We'd like to be the very best risk-adjusted performing fund, and that's where we really stand out. I don't know if you folks know what Sharpe ratios or Sortino ratios are. If you don't, certainly Jeff and Raheem and Dave can tell you all about them. But the measures risk-adjusted returns. A real simple metric in the middle of the page, which our institutional investors live and breathe, is up-market, down-market capture ratios. If you look at all of our returns since inception, during months when the stock market was up and months when the stock market was down, how did we do on average in up months? How did we do on average in down months? Up market ratio is pretty good, almost 70%. We're a long short fund. We don't use long side leverage. We never have full exposure to the market. But our down market capture ratio has been negative to low since inception, which means that on average, when markets are down, our fund is flat to positive. We believe the best way to make money for investors is don't lose capital. If you don't lose capital, you're probably going to do pretty well. And the reason that, in our view, the most significant factors contributing to the 13% compound annual returns over the last 13 years are not years like 2020, when our funds were up between 16 to 26%.
2019, Jeff, sorry.
Sorry, 2019. Thank you. It's years like 2020 and 2013 and 2015 and 2018. 4 of the prior 8 years where REITs had negative performance, the REIT index, or the broad market was negative, or both, and Vision delivered positive returns. That, we believe, is a key. Don't lose capital. We're doing a very low correlations to other asset classes, so, to REITs themselves, low correlation, and a negative correlation to bonds since inception. With that, maybe we'll turn to Darren a little bit of our outlook presently. Perfect. So it's an interesting time. even after the recent increase in interest rates, the spread between REITs cash flow yields and investment grade bonds is 261 basis points versus the long-term average of 96 basis points. That's a pretty big gap. Said another way, the implied cap rates that REITs are trading at compared to investment grade bonds is 240 basis points versus the long-term average of 170 basis points. Pretty interesting. According to Green Street, which is a leading independent, i.e. not sell side, real estate research focused firm, they believe that the balance of the current year REITs need to appreciate on average 16% to restore that relationship between REIT prices and investment grade bonds. Of course, we don't invest on average. What does seem apparent is that global monetary authorities are determined to try to keep interest rates lower for longer. Likely through yield curve controls. You may remember Operation Twist by the Fed in 2011, where they sold short-term treasury securities and used those proceeds to buy longer-dated treasury bonds to keep long-term rates lower. This is likely the mechanism or something similar that they will use in order to achieve their policy objectives. And no surprise, excuse me, when interest rates are relatively low and or increasing, that it's difficult to make money in bonds. And so there's a $345 billion of dry powder sitting with Blackstone, Brookfield, pension funds looking to increase their weight in real estate from 5 to 10% to 15 to 20%. Private equity funds, fully funded, looking to buy properties. That's going on in the property market. As we said, we'd rather not compete with Blackstone. We'd rather sell to Blackstone. We've done that on 2 occasions over the last 3 years and participated with them in a third one recently, which maybe we'll come to in a moment. But this is a very strong underpinning for REITs because there's an arbitrage between the public and private markets that is relevant to real estate, different than any other asset class. And that comes back to those 18 takeovers we've had in 12 years. The other thing right now, I mean, if we were talking 2 months ago, we would have talked about the prospect of inflation probably being transitory, being really fostered by all of this government stimulus to ensure the economy's on solid footing. Today, I'm not sure it's transitory. This looks like it's here and it's staying for a while. All kinds of market indicators over the last 4 to 6 weeks. You had record purchasing manager index recording in February. You have manufacturers in different industries, 3M, Walmart, Williams-Sonoma, Mattel, all flagging rising costs. It's not just oil and lumber. You're seeing material costs rise rapidly. Now, as most of you probably appreciate, inflation, generally speaking, is a very good salutary impact to real estate. Hard assets, replacement cost valuations go up. That obviously continues to be the case. And you're seeing it in particular in the industrial market today, in markets where there's very tight supply and demand. I mean, take the Toronto industrial market. It's the lowest vacancy rate on the planet. Land prices have skyrocketed. Construction costs have skyrocketed. Development charges by the municipality are extremely high. And the replacement cost rent you need to justify new development is basically $14, $15, which is triple where rents were 5 years ago. And if you combine these last 2 themes, the prospect of interest rates being lower for longer and inflation at the same time, this presents a situation for real estate we've never seen in my lifetime. Typically, where you have inflation, you have higher interest rates. If the Fed is successful and the Canadians and the Europeans are successful in keeping rates low for longer, this is a very, very interesting time for real estate, where you have the prospect of lower mortgage interest costs because of lower interest rates and yet property valuations going up because of inflation. We've never seen this before, and I don't know if it's going to happen, but it's certainly the policy objectives are in place for that to happen today. Brett found this slide. It's chart. It's an interesting slide. If you look at the best performing REIT quartile and the worst performing over the last 20 years, the difference between the best and the worst, 47%. That's interesting. If there's ever a sector that seemed to warrant a more active approach, real estate would be amongst it. But we don't invest on average. And as I said, we're not here to be bulls for real estate. We see winners and losers coming out of this pandemic. Winners, single family rental homes. These are homes between 1,100 and 1,800 square feet that you can rent. Primarily in the Sun Belt is our focus, and they rent between $1,200 and $2,000 a month rent. Lower rent per square foot than an apartment. You get a backyard, you get a garage. It's typically families that choose to locate there based on a local school district. Those were factors in place before the pandemic, but this sector is getting a boost from the pandemic because you're seeing a move from transition away from apartments, away from common areas, away from elevators to single family rental homes. You mean I can move there, get a place to work from home, or homeschool my kids in the back of that house and pay lower rent per square foot? I'm in. So this is very interesting. And this has become the darling asset class. Every institution on the planet is trying to figure out how they can get exposure to this asset class. And most of the prescient ones recognize that you need to have an operating platform in tow because you need scale. You need to have clustering of assets to make this efficient. You need to have best of breed technology in order to get any reasonable margins. And it's interesting as well because this asset class, you get two kicks of the cat. The reason we're invested in, most institutions invest in it, is because of the stability and growth in the cash flow. You're seeing 7-8% every quarter, year over year, new lease renewal spreads. That's a big spread. That's the core reason. But they own houses. The home prices are going up. They can choose to monetize that by selling the house. More significantly, in our view, when it comes time for the credit rating agencies and them to raise new debt financing, the key factor that the debt, the rating agencies look at and their underwriters look at is loan to value. How much debt do they have as a percentage of the value? Well, if the key value is the appraisals on the houses. If the houses are going up, their leverage is coming down. So this is an interesting space. The fundamentals are outstanding. Industrial, we've been talking about this with you folks for years. I think about 5 years ago, we coined the phrase industrial is new retail. Everybody gets it now. E-commerce, in the pandemic in March, e-commerce sales as a percentage of total retail sales spiked to 25%. 25 even going back to 6. Everybody gets this now. It's old news. Logistics, e-commerce, supply chain. It's powerful. It's real. It's long-term. But because of the pandemic, industrial real estate is benefiting from two additional secular long-term positive fundamentals. What do I mean? Number one, Canada couldn't rely on the United States when Donald Trump blocked our masks from 3M last April at the border. Do any of us want to rely on China for pharmaceuticals? I don't think so. Last August and September in New York City and Walgreens and Duane Reade, there was a shortage of Tylenol. So the first factor I'm referring to is the return of manufacturing to North America, onshoring and nearshoring. This isn't going to happen overnight. These are 50-year decisions, and we like that, long-term stability. But it's significant. We met with two chief economists of global banks in the last 4 months, and they both not only agreed with our thesis, they've quantified it. They believe 20% of all U.S. imports from China will be manufactured onshore in the United States. That's a big number. The second factor is, when I was in business school in Chicago in the 80s, the big operations class focused on the Japanese concept of just-in-time manufacturing, just-in-time supply chain. Just-in-time supply chain's done, it's over. Now it's just-in-case manufacturing. Nike will still make shoes in Cambodia or China or Vietnam, but Nike will have additional inventories and redundancy in their supply chain in Western economies. Today, if you look at inventories as a percentage of sales in the United States, they're 10% below long-term averages. We believe they'll move to 10% above long-term averages. So you combine these three factors, e-commerce, logistics, onshoring, nearshoring, and redundancy in supply chain and additional inventories, the fundamentals for industrial look very positive. We watch supply. It's easy to build this stuff. It ain't so easy to build in Toronto, Montreal, two best real estate industrial markets on the planet. But, we watch the US, South Dallas, there's a pickup supply. Chicago, around the Atlanta market, there's two submarkets, and Central PA. But that's it. And nothing that normal course absorption that I'm talking about isn't. So you're seeing significant growth here in industrial. Retail bifurcated. Very negative on malls. People, traffic will come back to the malls. Malls will have a vibrant customer base. But those fashion tenants that were paying $200 a square foot rent, that's not happening anymore. Valuations of malls are coming down. And, unless landlords figure out how they can extract a portion of e-commerce sales from a geographic region, and that's going to be years before that battle sorts out. But the high-end tenants can't afford those rents. And they're certainly not going to pay the common area charges on top of the rents. And the tenants, again, when I was in the real estate industry, at Bramley too, the tenants nobody wanted. You never want a theater. They didn't have a covenant. A fitness center really trashed your mall. Keep that Vic Tanny's in the basement. Restaurants, no, I really don't want restaurants in my mall. Well, those are the go-to tenants today. That's what you want. You need those tenants. They create traffic. They create activity. They make the mall vibrant. The problem is those tenants can't pay those rents. They'd be lucky to make money at $35 square foot rents. And so the valuation of malls are coming down. We're more constructive on necessity-based retail, the grocery store anchored, pharmacy anchored shopping centers. Valuations come way down. I'm not sure how long we'll be in this trade, but we're in there today. And most of them are really well managed. And because their land position is primarily the ones we're focused on are urban centers, they're really benefiting from their land positioning and the ability to do mixed use, build apartments and other uses on those lands. Canadian apartments, for those of you that are familiar with Vision and familiar that we write this 35-page reporting letter every quarter. And if you'd read that letter every quarter for 12 years, you would have found a big weight to Canadian apartments. We never went away from Canadian apartments until last spring. We sold down our Canadian apartments significantly. Why? Because the big gap between market rents and in-place rents was being driven by immigration. Everybody wants immigration. Immigration is going to come back. But last spring, there was no immigration to speak of, and there was no visibility when we're going to get it back. And so for the first time in my lifetime, we saw significant and widespread tenant inducements in the Toronto apartment market. 1 month free rent, free microwave ovens, free Amazon gift cards. You see that in Calgary. You see that in Dallas, Texas. You never seen that in Toronto. And so we sold down significantly. The timing was pressured and the stocks had a big correction. By the end of the year, last year, we got conviction with reopening of the economy that this was going to be great. As I said, everybody wants this immigration. Due to the ineptitude of our prime minister, I don't want to be political, but incompetence is an understatement. He promised us, you remember, 100 million vaccines last fall. He just blatantly lied. kick the can down the road here for a quarter or two, but Canadian apartments are going to come back. You're going to see immigration come back, 1.2 million people over the next 3 years. That doesn't include 700,000 foreign students in this country every year. And God willing, Canadian students will be back in campuses in the fall. This bodes well. You're going to see a big recovery in Canadian apartments. We thought we'd wait till the end of first quarter. Thankfully, we didn't, because the fourth quarter wasn't as bad as we thought it might be. So we've come back into Canadian apartments. Office. Those of you who have familiar with our strategy, we've never really been constructive in office. I've never seen anybody in history. I grew up in office. Andrew Moffs covered office for years. I've never seen anybody in history with a buy and hold strategy office make a reasonable rate of return. You can't do it. You can buy it 88%, you can lease it to 95, you can sell it, you can make good money. But to sit there year after year at 95% occupancy and think you can make money, you can't do it, because the capital expenditures kill you. It's not the retrofit of the lobby or the parking garage. It's the tenants. Every time you need to lease that space, you got to give free rent and pay tenant improvement dollars. Now, so this was the landscape before the pandemic. Now, since March of last year, when you've had the CEOs of HSBC, Bank of Montreal, Goldman Sachs, Shopify, Twitter, Salesforce, Facebook, Target stores, all come out publicly and say their workforce has worked really well in a remote work from home environment, their long-term demand for office space is going to be lower. We believe that. We believe there'll be a 15% long-term reduction in office. Now, it's not going to hit these office stocks right away because they have covenant tenants with long-term leases. But already you see 20% decline in net effective rents in places like New York, Boston, Toronto. And so this is a long-term theme that we believe in. You can see, if you flip the slide, you can see our positioning at the end of April. The multifamily looks higher than I indicated, primarily because we have two non-Canadian investments that are in that bucket that we like a lot. One is Irish Residential REIT, which is in Ireland, the only Irish apartment REIT. There's a massive housing shortage. It's the youngest population in Europe. Big tech boom going on there. It was sponsored by Canadian Apartment Properties REIT. And this next investment is similar, European Residential REIT. This one's listed in Canada, which is all apartments in the Netherlands. Other than that, home builders, we typically haven't been invested in home builders over the years. Today we are. We see this cycle being longer, higher for longer, or going on longer. Everywhere in North America, including Calgary. I know one of the questions. Everywhere in North America, record home sales, records. And it's really different than last cycle because the balance sheets of those home builders were dramatically changed since the last boom in 06, 07. Much better balance sheets. Even with the spike in lumber prices, the home builders have been able to pass those on. We think as long as U.S. mortgage rates don't get above 4%, this sector has legs to it. And we've got some hedges in place to protect against that. I know the guys wanted me to comment on the recent relationship with Morgan Stanley and bring it into context what's meaningful to our participants on this call. So we were approached at Vision in February 2020 by JP Morgan. My apologies to JP Morgan. JP Morgan out in New York. They said they've been tracking us for some time, and they'd be interested if we were, as they put it, up for the task to consider a 6 to 9 month rigorous due diligence process to consider Vision as the exclusive REIT alternative fund for the global high net worth, sovereign wealth, and institutional platform. Rigorous was an understatement. It was grueling. They had 3 teams of investment management due diligence, operational due diligence, and structuring due diligence, grinding us out every day for 2 months and then every week for 2 months. About 6 months into it, I said to Darren and Brett, do you realize if this proceeds, the new world we live in, we've never met these people. I mean, we didn't even have a Zoom call for 6 months. Anyhow, make a long story short, it was 10 months and we were informed in December 2020 that we got Global Investment Committee approval to proceed everywhere but Canada for regulatory reasons. And they began allocating to the same funds that are available to you in March. And what is interesting in our view and relevant to the participants on this call is that we can demonstrate unequivocally, if Vision was larger over the last 13 years, the returns for our investors would have been higher because we had limited credibility to influence the outcome in some of our active investing initiatives. You know, those 18 takeovers I mentioned in 12 years, I mean, some of them went too bloody cheaply. And, you know, we were asked to get involved in certain situations. I remember you're in Western Canada. Some of you may be familiar with the Mauer funds. I remember the biggest holding in our fund the first couple of years was a company called Parkbridge, which was in manufactured housing communities, a sector we loved. It was a huge weight. Anybody who would listen, you know, Jeff Olin ad nauseum would talk about Parkbridge. Well, BC Pension Fund got it. They announced a takeover bid at a 30% premium to was trading after it had doubled in our fund. And I remember we had put Mauer into the name. We're collegial with them. And Martin Ferguson, the chief investment officer at the time, called me up and he said, Jeff, you don't get active. This is too cheap. We said, Martin, you get active. We own 3% of this company and you own 15%. I assure you, if we own 15%, we and all other shareholders would have benefited. And so we think this is constructive. Already, I'll note the fund has benefited in the last 18 months from, as of this week, 5 what's known as wall crosses, where we get a call. One case was from RBC, one was Morgan Stanley, one was Citi, one was their own initiative. They ask us if we're prepared to be restricted from trading for 3 or 4 days to receive confidential, non-public information in order to disclose to us a proposed transaction. And they got our views on structuring and pricing of the transaction. What they really want is they really want us to participate in that transaction. Now, it's typically management teams that tell them to call us, and so they know we're going to like it. So we typically say yes. A picture paints 1,000 words. The most recent one until this week was last fall. Morgan Stanley called us up. They said, guys, you restricted what name? Tricon. Yeah, it's been a big holding for a year and a half. What's up with Tricon? They told us they were negotiating with Blackstone on a $250 million US exchangeable preferred share investment with a 5.75% dividend and exchangeable into common shares at 11% premium to where it was trading at. And we thought it was trading at a 25% discount to the underlying net asset value. In fact, we speculated the moment this was announced, the stock would go up 10%, which it did. Now, if you read the press release announcing this transaction, where they describe a $300 million based on our interest, and it says Blackstone and a few other investors, they don't mention Vision, but that's fine, proceeded. Blackstone was a pioneer in this space. They sponsored the creation of Invitation Homes, which is the largest player on the New York Stock Exchange with 80,000 homes today. They took them public. And over a 2-year period, they exited that investment, concluding in December 2019. So for Blackstone to re-enter the single family rental space and do so through Tricon was a huge validation and testimony to Tricon. And if you read that press release I referred to, the CEO of Blackstone is quoted as saying Tricon is the best in class operator in the space. We agree with them. So already it's helped. I'm sure the guys are interested. Our assets under management today just passed 800 million before really the rollout of JP Morgan. And so we think that's constructive. It's a $2 trillion universe just in REITs, just in equities in North America. We don't move the needle to we're $2 billion. And so we think that this JP Morgan support will be constructive to all of our investors. Been
Just
talking
another-
for a while. Why don't we open it up to questions?
Sure. Just another note on JP Morgan before I hand it over to the guys. After 10 months of due diligence from JP Morgan, they condensed it into one sentence. They said, Vision has delivered double the returns of the index with half the volatility. And I said, it took you 10 months to figure that out, but thank you.
Anyhow, you guys don't need JP Morgan to do your due diligence. Dave and Jeff and Raheem do a fine job, but I do think it's constructive in terms of the ability for Vision to be more active.
Jeff, Raheem, Dave, over to you.
Thanks, Jeff. We've known each other for a long time, and I think you guys know we do the same amount of due diligence for our clients and our fund and portfolio set. Something you mentioned, suburbanization. Do you think you're going to see a reworking back to urbanization over the next 18 months as people start to leave the downtown core? Do you suspect that on a per square foot or even a valuation basis, downtowns may start to look cheaper now because everybody's gravitated and they kind of move like a horde per se, and they move around. Thoughts?
Yeah, the core of your question, I think the answer is yes. I mean, cities, we've been in a 1,000-year, 2,000-year trend to urbanization. I don't think this pandemic is going to change that. I think the reasons to be in cities will continue. I think young people will come back to the cities. And I think that I think the answer is yes.
Another question that comes up quite often with clients, and it's inflationary per se, but people sometimes forget that our wages also at times participate in inflation. The movement of labor costs and lumber costs and building costs are going to be passed on to the consumer naturally. Do you suspect that we're going to see a surge in pricing, especially on the residential real estate side, just to keep up with the inflationary costs? Or do you think this is more of a short-term movement and it's almost like a reset, and then we'll revise back to more normalized levels? Because at the end of the day, I don't think they want to overheat the economies. They want to keep interest rates low, but they will if they have to move things quickly just to keep things in check. So again, should people start looking at the averages as higher per se?
I think yes, but our blood at Vision is supply and demand. Some of the cliches and adages about real estate we think are nonsense. Location, location, location. I mean, you can have the best located office building in downtown Calgary. How's that going for you? Interest rates. We didn't talk about interest rates, so I should talk about that in a moment. But it comes down to supply and demand. And, if through all of this stimulus, if you have employment growth, that is going to speak, that's the demand side of the equation. Supply, how many buildings are out there? How occupied are there? How many new buildings are coming on? Are they pre-leased, pre-sold? Yes or no? Work, but you can do that work and get some answers. Demand's harder. And the key side of demand is employment growth. So if you have solid employment growth, I think the answer is you're going to continue to have strong markets. I mean, if you got a job, you can buy a house, rent an apartment, or you're working in an office building, or you're working in a factory, or you're traveling and staying in hotels. And so watch supply and demand to get your answer. And, I think this cycle is longer. People think what has happened through the pandemic. Yeah, there's a short-term factor that, your visa bill is 2 pages, not 10 pages. That you're not traveling and you're not going on staying in restaurants, and you realize that quality of life and your kids driving you crazy and you need more space to work from home. So when it goes away, but I think some of those quality of life factors will resonate, and so I think the demand will be more salutary as long as employment growth. Not the unemployment rate is misleading, employment growth.
But it's also, but it's also very geographic. I mean, you look at what's happening in Phoenix and Austin and Orlando versus San Francisco, right? You got this massive movement to the Sun Belt versus the coasts.
Yeah, I mean, it depends when you're talking about single family or condos. But rental apartment. I mean, to his point, San Francisco. rents are down 31%. And that place is a disaster. I mean, it was a disaster before the pandemic. I don't know when the last time any of your clients were there, but they have a huge homeless problem, and the local government is doing nothing about it. I mean, you can walk out the fanciest hotel, and it's dangerous. And so in December, you had 5 Fortune 1000 companies move in December from Silicon Valley to Texas. So there is geographic dispersion about that, but generally speaking, I think single family homes in most markets, I think, will be solid. Don't ask me about the condo market in Toronto. I've been wrong for 10 years about that. Thank God there's no public companies there. Interest rates. Let's talk about interest rates. This is the biggest myth in the REIT world. It's the elephant in the room. And really, remember, we're not here to be bulls for real estate. But the myth is based on the simplified valuation equation. Value equals net operating income divided by a capitalization rate, a cap rate. All the rhetoric in Barron's and the Wall Street Journal and Globe and Mail is interest rates, cap rates, interest rates, cap rates. I note that interest rates went up and cap rates have come down. Forget that fact. Interest rates, cap rates. But cap rates are the denominator. We can't do anything about that. What we can do, and what we do is focus on the numerator, net operating income. Because in our experience, as I just went through, 100% of the time, supply and demand trumps interest rates. Again, interest rates could be going down. You got too many office buildings being built in Calgary at a time when there's a secular reduction in demand. The lawyers don't have law libraries anymore. Calgary office building values are going down, not up, when rates are going down. Same thing when rates go up. You must ask yourself, why are interest rates going up, to answer the question. If rates are going up because of a credit crisis, that is brutal for real estate. If rates are going up because of inflation, it's good for real estate. And so this is key. I mean, between the last major Fed tightening schedule was 2004 to 2006. Between June 2004 and June 2006, the Fed raised interest rates 17 times, from 1.25% to 5.25%, 400 basis points, 2 years, 17 times. Over that period of time, REITs returned 58%, stocks 15%, bonds 6%. REITs aren't bonds. They're dynamic businesses in evolving markets where supply and demand trumps interest rates. And this is not an anomaly. If you look at it historically, as the prior chart showed, it's happened in history since REIT started. And you saw it, as the next chart indicates, in the past year, where last August, the 10-year US Treasury was 50 beeps. March 31st, it was 170 beeps. And over that period, REITs were up 38%. Why? Because there was a perceived strengthening economy coming in the pandemic, jobs, employment growth. And so you really have to understand why rates are going up to make a judgment. And certainly right now, we're pretty constructive. Any other questions?
Just quickly, this is a very, I would say, quick market in terms of the directions it's been moving the last year and a bit. One of the things that we really like is just how you can change your thesis and move very quickly. Can you just highlight a couple examples again for us? Just
Sure.
I think it's very important, and something that's on people's minds is values in the stock market and other things move higher. And I think it's a valuable asset to have everyone, or to have at your disposal for any investor.
Sure. Let me give you 2 or 3 quick examples. One we already touched upon was the Canadian Apartments, where we were there forever. I mean, people thought we were married to Canadian Apartments. We sold them all last fall, and then we came back in. But most recently, manufactured housing communities, I say again, a sector we love. The fundamentals are outstanding. We've got it green here because the fundamentals are good. But we just sold all of our manufactured housing community because the market really took them for a ride and they're way up and we thought they were fully priced. We'll be back in at some juncture likely, but they're trading at big premiums in net asset value. Seniors housing. You know, we had a significant position in Chartwell coming into the pandemic. Thought the stock was worth $17.50, $18, was trading around $14.50. Well, there was one day there that second week in March, we plugged our noses and we sold 100% of our Chartwell in one day. 3 days later, that $14.50 stock was trading at $9. And you know, we like it there, but you know, what's happened, of course, is they're retirement homes and there's a natural attrition in the occupancy due to people passing away or moving on to nursing homes, but their doors have been largely closed to be able to rent to new residents. And so occupancy erosion has been occurring. And that speaks to another thing we're able to do in public markets, and a bit of an update for you guys as well. Is starting last March, we got a new arrow in our quiver. As you know, and as you touched on, volatility has been very high. As you also know, volatility is a key factor driving option prices, puts and calls. Option prices have been high. We took advantage of that by selling volatility, using a very low risk, low capital outlay to get exposure primarily on the long side to names that we liked a lot at prices 10 to 15% below the current market and collect a lot of yield. So, and also writing calls on names we like to short or perhaps we were long that we would trade out at higher prices. And rather than waiting for it to get there, we're collecting that yield now. So let me give you a very specific example and then bring it back to Chartwell. American Homes for Rent, single family rental housing sector, stock we loved. We wanted to buy that stock for 2 years. We never owned it. It was too expensive. Stock was trading at 30. We wanted to buy it at 25. Last March, we finally, market corrects. We take a long position in American Homes for Rent at $22.50 a share. We're really happy, but we don't buy our full position. In addition to buying a long position at $22.50, at the end of March, we wrote puts that expired on the 17th of April. We collected 70 cents by writing that put. 17th of April comes along, one of two things happens. Either the stock we loved at 25, we bought at 22.50, is now below 20, and we're buying it at 19.30, or we did 158 of these trades last year. 143 of them, we just kept the premium. So we don't know about gamma and all these complex option trading things that these stock jockeys do. All we're doing is applying a fundamental valuation lens to a sector we know really well, saying, wait a minute, I love the stock at 25. I buy it at 22.50 and you want to pay me to buy it at 20? I'm in. So come back to seniors housing, Chartwell. What we've done in Chartwell is when the stock was lower, and we thought when the economy opens up, Chartwell's going to do really well. And so we wrote, stock was around $11. We wrote 9 long, these are long, not short term, 1 year out, puts at $9.50, which means if the stock gets to $9.50, we buy it at $9.50. Stock's at 11. And we took those proceeds from writing the put that we collected and we bought a call, exercisable at $12. We have no cash out there. Our only risk is we're going to buy the stock at $9.50 and we're going to buy that stock anyhow at $9.50. So we're putting out no cash to get long-term exposure to Chartwell being above $12 1 year from now. And so these are things you can do in the market that you can't do by calling colliers or CBRE.
Jeff, we got a question from one of the attendees on your view on self-storage.
We like self-storage. We like it a little better in Canada and the United States. Last year, there was a lot of supply, or year before, supply in the United States, but that's worked off. So we kind of like it in the US too. But we like it better in Canada because there are 8 square feet per capita of self-storage space in the United States. In Canada, that's number 3. That's a big difference. Now, 3 is not going to 8. There's reasons for that. US South, there's not basements in houses. That Americans tend to move around more than Canadians. But we think 3 is going to 4.5. So this is a space that is, typically does well in periods of economic contraction. I think it's called the 6 Ds to drive demand: divorce. I won't go through them all, but you lose your job. Obviously, there's all kinds of factors, but generally it does well. We like the space. Great name in Canada, Storage Vault. It's a corporation, not a REIT. Generates a lot of cash flow to grow right across the country.
That's great. Thanks, Jeff. Darren, appreciate it. I think we reached the top of the hour. Always phenomenal to hear from you guys. Deep insights. And the key thing is something we've always known, but now that JP Morgan has endorsed you, it just speaks volume to the active management, the value creation opportunity, and looking at all markets and looking at through, a lens of a background in real estate and really combining analytics and mathematics and logic. And, our clients are very happy, and to access Vision, you can do it on a standalone basis or through our MyWealth portfolios. We'd like to thank you guys for joining us. It's always a pleasure to speak to you guys and hear your thoughts on where things are going. And we really appreciate your time. So on behalf of myself, Jeffrey Hunter, and David Townshend, we really appreciate everybody participating today. Thank you.
Thanks very much. Have a great afternoon.
Thank you, everyone.